Hello and welcome to my show where I talk about interesting stocks. And if you're cool and you like cool stocks, then you might consider subscribing to my channel and liking this video. And I got to be honest with you guys, it's been a frustrating experience. I have recorded this video twice and I even uploaded. I edited and uploaded, and I say edited very lightly because my process, if you've been paying attention to my videos, is very low effort. I auto edit, I auto caption, and I upload because I will be the first to admit I am just trying to get content out there, quantity over quality right now, hoping that somebody out there is paying enough attention to care what I have to say. Sadly, the video that I uploaded to YouTube just now, a few moments ago, there was a technical issue with it. I made it all the way to Premiere. I shared it with my friends. Noticed that it made me look like more of an idiot than I am. Therefore, I am redoing this video for the third and hopefully final time. And in doing so, I am also drinking a beer. And while I cannot guarantee that drinking beer will make you a better investor, I can guarantee that beer is delicious, especially when cold. Hits the spot. So, today I will be talking about Republic Services Inc., ticker RSG. Trash is cash, ladies and gentlemen, especially for this company. And I'm sure you might be familiar with them, they are everywhere, all across North America. They pick up trash. Not only do they collect trash, but they transfer trash at many of their dedicated transfer stations. They even have over 200 landfill facilities that they own that they are using for their own vertically integrated collection services and for third party business, collecting the trash from other trash collection companies, uh, collecting revenue at those landfills. This is a beast of a stock, or has been. We see the 10-year performance 450%, crushing the S&P 500 in that time frame. Why has this stock been such a good performer? It's simple because it is recession resistant and the management team has made smart decisions about how to grow the business. So, today I will be talking about the overview of this company, a little bit of background on it. I'll be doing an analysis of their financials, the valuation, taking a look at their dividend, talking about the thesis underpinning why this stock has seen massive multiple expansion in recent years, contributing to its strong outperformance. I'll also be discussing some of the risks associated with this investment opportunity, as well as my grade. What do I think about it? Disclosure, I do own shares of this company. I do like this company. This is not a recommendation for you to buy it. It is a demonstration of my opinion and my analysis on the company. And last but not least, I'll be doing technical analysis on the long-term chart, as always. So without further ado, let's get into it. Republic Services, Inc. It's a North American waste disposal company founded in 1981. So here's what's interesting. It was owned by a company called Republic Industries, which spun out Republic Services in 1998 and then changed its name to AutoNation. That's right, AutoNation was the original owner of this company. And here's what's interesting. This gentleman, Wayne Huizenga. Huizenga was the founder of AutoNation. Interestingly enough, Mr. Huizenga, also the founder of Waste Management Inc. And for those keen observers out there, they will note that Waste Management Inc. is the largest player in the waste collection business and the chief and primary competitor of Republic Services. Mr. Huizenga is also the owner of Blockbuster, the Miami Dolphins, the Florida Panthers, and the Miami Marlins. Wow, what a resume. Interesting that the top two waste management and collection companies in North America and arguably the world had effectively the same founder. This Huizenga guy understood trash. So, what about today? Well, the current company took shape in June 2008 when they acquired Allied Waste Industries in an all stock deal. The merged company retained their public services name. Yeah. So that is just one, probably the most notable in a large string of acquisitions that both this company and Waste Management have made over the years. The industry originally was fragmented. Mr. Huizenga noticed that he could make boatloads of cash by acquiring other waste management companies and rolling them up underneath his own. Thus, a star was born. So now this market has two major players at the top and a lot of small players underneath. And the main growth driver for these companies, aside from sustainability initiatives, which we'll get into, is acquisitions. So here's the thesis behind the company. Let's talk about multiple expansion. Super exciting topic. The price return here. So this is the price per cash flow ratio of this company over time. And you might notice started on this chart 7.5 roughly. Now trading at effectively an all-time high of 17. There was a temporary blip here, conceivably due to low cash flows, not a drastic increase in the share price. This is multiple expansion, folks. So why has the market generally tended to like this company more over time? Well, there's several reasons. One, it's highly efficient at turning trash into cash. Let's take a look at their income statement on an annualized basis going back to fiscal year 2014. Revenues in 2014, 8.8 billion. Today, just shy of 16 billion. That's not quite a double. However, if you notice, gross profit 3.16 billion to 6.7 billion. So, mental math tells me that while revenue has not quite doubled, gross profit has more than doubled, indicating better margins. Also, operating income 1.2 billion in that same year, up to 3.1 billion. That's right, profits are increasing faster than revenue. So does this company have a moat? Absolutely. Just because of what we just looked at, that's not the reason. However, it is evidence. Here is the reason, if I can find my report. Here we go. The reason for this moat is as such. The company has 364 collection operations. In other words, 364 markets where they pick up or collect trash. 246 markets where they transfer the trash from one receptacle to the other. 74 recycling centers. Here's the key, folks: 207 active landfills. Irreplaceable, critical infrastructure. Eventually, they get too full. They have to be closed and they have to open a new one. However, while they exist, they are essentially irreplaceable infrastructure. And there's usually only one at a time in a particular market area. So that implies vertical integration. In other words, they are collecting, transferring, and placing or disposing of the trash in the landfill. They're collecting revenue along each piece of that value chain. The saltwater disposal, deep injection wells, treatment storage, blah, blah, blah. That might also be a component of the integration. However, I'm not smart enough to know what that means without doing more research. However, let's take a look. This is their most recent earnings report for the quarter ended September 30th. They are kind enough to break down their revenue across different segments of the business, which I love. They also write out these percentages here. as for the attribution of that segment to the total revenue. We see here in the quarter, 4 billion of revenue, up from 3.8 billion, roughly 4.1. That's high single digits, doing the math in my head, revenue growth. So we see here collection, 2/3 of the revenue attributed to collection of the trash, 5% to transfer. Notice these intercompany amounts being netted out. In other words, this transfer business, they are handling their own transfers and handling transfers for third party customers as well. Customers being other trash collection companies. Same thing with the landfill. So, of $768 million of landfill revenue was within the company, but 452 or 53 million of net landfill revenue, 11% of the revenue coming via the landfill. Here's what is sexy to me. Picking up trash, putting it in a landfill, it doesn't get much sexier than that. But if it were to get sexier than that, it would be to the tune of environmental solutions and recycling, processing, and commodity sales. That's right. They are getting paid to collect trash and recyclables, and they are also getting paid to sell the recycled material back onto the open market. In addition, the recycling solutions, this is where it gets really sexy. The recycling solutions, or excuse me, the environmental solutions. Take a look at this. We are engaged in 76 landfill gas to energy and other renewable energy products. They are taking garbage and they are capturing the greenhouse, they are capturing the gas emissions of the garbage. And I'm not a garbage scientist, but that's the idea. They're capturing the emissions and they are creating natural gas out of that, and then selling it on the open market. This company is a environmental sustainability investment. So now we get to see, in addition to the fact that their underlying core collection business, since that is recession resistant, it's already a sexy business. But the fact that they are essentially an ESG play, a sustainable investment. They are contributing to a sustainable future, sustainable energy producer. It's a small amount of their revenue, but conceivably could become more over time. Because they are a sustainable energy company, in addition to being a trash company, they are sexy in today's environment. There are plenty of institutional investors that will not touch fossil fuel investments. They won't buy tobacco stocks. I will. They won't. And they instead will plow their capital into this because they have to. It's part of their mandate. So, does this company have a moat? Like I said before, absolutely. They own the irreplaceable real estate, allowing them to vertically integrate up and down the value chain on top, in addition to that. And they are now even creating energy from the garbage and recycled materials that they are selling. Super interesting, right? It's no wonder why this business is trading at a historically expensive valuation. In fact, when we looked at that chart before, we saw that their valuation metrics were basically historically high. Speaking of historically high valuation, this is their dividend over the last 10 years. It is the lowest that it has been in that period, implying that it is expensive versus history. Their free cash flow yield around 3% is indicative that the market is pricing this as a very safe investment. Too safe? Not safe enough? I'm not sure. But what I do like is this. These are the dividends paid out over time. Let's go all the way out. The first dividend being September 25th, 2003, 4 cents is now 58 cents a quarter. So I don't know about you guys, but I don't see a single year where they cut the dividend. In fact, they've raised it for 20 years in a row. This is sexy, but expensive. Coming soon. Seeking Alpha gives it fairly poor valuation metrics across the board, understandably. The price earnings growth ratio, 3.32. I would say anything above a 2 is, depending on what it is, fairly expensive. 35 times earnings, that's expensive. 4.25 times sales, 6 times book. It is trading at a massive, massive premium. We briefly went over the income statement. Another thing I'd like to highlight, the shares outstanding have decreased from 357 million to 315 million, a little bit more than 10% in that time frame, which has allowed them to compound diluted earnings per share quicker than otherwise. But one thing I really like, this payout ratio has gone down over time, 69% to 34%. Income statement looks great. Let's look at the balance sheet. 83 million of cash versus 12 billion in debt, long-term debt. How are they able to sleep well at night with such little cash? This is why. 80% of revenue has an annuity type profile, meaning that it's predictable and recurring revenue. In fact, a lot of their contractual revenue, at least in the go forward in the most recent years, has been indexed to inflation. A lot of their annuity type profile is indexed to inflation. So, in other words, management's tendency to keep such little cash on hand. They have more cash now than they've had most of the last 10 years. The such low amount of cash relative to their enterprise value is indicative of the strong recurring revenue profile and strong operating performance of the underlying business, signaling management's confidence in the underlying business and the predictability of those revenues. So while this balance sheet does not look outstanding, it is highly leveraged in one sense. I would not say that it is a concern, and it leaves clues as to the nature of the business. So here's the deal: this is a phenomenal company. Stock, and what I mean by that, we'll just do kind of a simple visual trace here on the chart. We see in the 5-year time frame, it basically sold off. It did outperform slightly over the S&P 500 during the COVID crash, at least because of the prior few months. It was up. We see here during the most recent bear market in 2022, it traded flat. In fact, it hit a new all-time high in the middle of that bear market, unlike the S&P 500. So why has it outperformed over the last 5 years? Because it outperformed massively in the last bear market. This is a defensive stock. Its outperformance, I would wager, largely attributable to outperformance in bear markets. Cash is trash. So is it a fair valuation? I would agree with what I'm seeing from the market that it is a premium company. It deserves to trade at a premium price. The underlying business is stable, growing. There's multiple growth levers here that make it compelling. It is expensive though. So what are the risks here? The majority of their revenue is, again, 80% annuity type profile. But what about the other 20%? The money that they're making selling the recyclables, the money that they're making selling the natural gas, the money that they're making otherwise. That's a little bit more sensitive, and it is sensitive to commodity prices. So there is a bit of commodity risk with that, but I would say that it's immaterial and should not materially impact the stock price during wide commodity price fluctuations. Another risk is, as with any expensive stock, is exactly that. It is an expensive stock. Therefore, the main risk in buying it at this price is that it's already expensive, and the multiple expansion that has driven a lot of the returns may not continue over time. However, Investors who love dividends may still feel compelled to own it, given that the yield plus the growth rate of the dividend, the growth rate being a steady between, let's call it 5 and 9%, I would say is a fair judge or fair estimate here. It's been 8% in the last year, estimated 7% in the forward year. 1% yield plus 8% growth is 9%. Inflation right now is 3-ish or less than 3. Your income return will strongly outpace inflation on this investment if you believe the forward growth metrics, which I do. So, the main risk here is not that the dividend will be cut. It's not that it will sell off harder in a broad market downturn because it has outperformed the index in the most recent bear market. There is a likelihood that will happen again. The biggest risk is sluggish returns due to an already expensive valuation. I would say that this is the most palatable risk to take when investing in a stock. The fact that it is already expensive but steady, and the income return is safe. So, what do I grade this? I grade it a buy, not a strong buy. It's not at a value price. However, I think it's smart for investors, really of all types, to consider gaining some exposure to this stock. I'm not recommending that you buy it. That's not what I do. I do think it is wise to consider how having exposure to this investment in your portfolio might maximize your risk adjusted returns. Whether you're an income investor looking for solid, predictable growth, whether you're a total return investor who believes that the total returns of the stock market are going to be 1 to 3% in a lost decade, I anticipate this stock will do much better than that in the next 10 years. Whether you're a value investor who wants to buy growth at a reasonable price and outperform in a bear market, you would consider this. If you're a defensive investor, this might already be in your portfolio, or you have hesitated to buy it because it looks so expensive. I don't think it's gonna get less expensive from here unless something really bad happens, and I can't really imagine what that is, but I'm not a genius, especially not after drinking a quarter of a beer while talking about this. I graded a buy. Let's do some technical analysis. See, this is what happened. I had to delete my cache. I had to restart my browser. I had to do all this stuff, then logged out, and I have to redraw my chart. And the worst part about that is I'm not in dark mode anymore. Okay, so this is the 1 year chart. Let's go back 5 years. Let's go back all time. Look at how beautiful that is. Just a beautiful, beautiful chart. It does appear to not be that volatile. Again, I'm just looking visually. A couple things that stand out. This trend line here. This is the COVID crash right here. Let's draw a line right here. I mean, it's been pretty tight, generally speaking, in this bound. What's interesting here is just a repeated bullish momentum bouncing off of this bottom trend line here. And the trend line has even accelerated up. Just a continued bouncing up. This is the bear market. This is the new high it hit in the bear market. These are week-long candles between October 23rd, 2023 and February 26th, 2024. There were 3 weeks where it did not make a gain. Super bullish right here, all the way to a new high almost every single week. Bounced down again, new high. It sold off very steeply here due to the market just getting a little overheated. But since then, new high. And it is currently trading at an all-time high. Well, just few cents short of the all-time high. And again, this is not sophisticated chart analysis, but it has broken above this pattern. So look, honestly, in my experience, when the S&P 500 is in a bull phase, and you have a stock that has good fundamentals like this one that's trading into it, there's not a lot of volume here, so that discounts it somewhat. When it's trading up above breaks out of the pattern that it's in. This is a weak pattern. It's not that recognizable. It's just some thing I'm looking at. So take that with a grain of salt, please. People who are more sophisticated at technical analysis, please feel free to check my work. But to me, it's just breaking up above. In my experience, it usually continues to trade up a little bit after that before getting heated. So look, um, I think it's safe to say, obviously, if you would have bought it anytime for a longer than a year long time frame within the last few years, you have gains. There's not a whole lot to be determined from that chart, but it does look very strong to me. The market has caught on to this stock. You're not early. Okay. This isn't NVIDIA. You're not going to make huge gains in a short amount of time. This is a steady, slow compounding machine, or has been and might be for the foreseeable future. So if you're interested and believe that this is a compelling investment, then expect slow and steady, not sexy, even though I think it's as sexy as it gets, clearly. So, anyways, that has been my analysis for public services. I think it's a good, simple to understand stock, particularly for beginners to the market. It's not complex. Everybody understands trash. It's something that we see every day that we deal with. If you're me, you always forget to put the trash out. And therefore, you might appreciate if there was more innovation in this sector where there was like some notification that hit your phone, a reminder to take out the trash. Anyways, I digress. This is an easy to understand stock that I think makes sense for a lot of different portfolio types. So, if you found this interesting, then please like this video, subscribe, and recommend something for me to look at next. Or give me some feedback on what you think. I'm very open minded and interested to hear what my viewers, all 10 of you out there, have to say. If you like my analysis, be sure to follow me and check in on Seeking Alpha, where I regularly write articles as well, in addition to doing these videos. So I look forward to interacting with you and continuing to deliver quality analysis on what I'm looking at. Because while I might not be the most sophisticated stock market analyst out there, I think I'm the funniest and sexiest. Anyways, this has been fun, and I will catch you soon on the next one. All right. Thank you. Till next time.